Hello and welcome to episode 71 of
Mo Money,
the investing economic show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, your host, your teacher, and your friend, MC Mo. Now let's get to the money. April, as most people do not know, is National Financial Literacy Month. Obviously, it is a drastically less significant month than the preceding months like Women's History Month in March, Black History Month in February, or who could forget National Bath Safety Month in January. That sounds ridiculous, but on average, 14,000 people die every year in the tub. So, stay safe, people. Anyways, in honor of Financial Literacy Month, we are going to explain a few terms that you may have been only pretending to know the definition of for years now. The first term is compound interest, which Einstein allegedly called the eighth wonder of the world. To put it complicatedly, compound interest is your principal amount multiplied by the total of 1 plus the interest rate over the number of times compounded per year, raised to the power of the number of times the amount is compounded per year times the number of years. Or simply, you start with a principal amount like $10,000, you earn 1% interest from the bank each year, and in 10 years it'll be around $11,000, just by you doing nothing. Compound interest is how many wealthy people go from well off to rich to wealthy. The second term is capital gains and losses. You know the juice head, beefcake lifting bros who are all about gains? Well, in finance, gains are equally important. Capital gains means profit. If you buy something at 100 and you sell it at 200, you have $100 in capital gains. And capital losses is self-explanatory. You buy at 200, you sell at 100, you have $100 in capital losses. But the bad part is capital gains are taxed. The upside is capital losses can be used to decrease what you have to pay on your gains. So, that's cool. The third term is FICO Score. This was a score created by the Fair Isaac Corporation that determines your credit score. Your credit score determines how risky of an investment you are for a loan. The higher your credit score, the better chance you have of getting jobs, loans for a home, getting an apartment, pretty much everything that involves finance. 750 or above means you're a safe bet for a company. 580 and below means the company might as well just throw the money into a fire. And if you do have a low FICO score and you get approved for a loan, the interest rate on that loan will be much higher than if you had a better score. So watch out for the fine print. The fourth term is inflation, or what some people refer to as the silent tax, but others view it as a sign of economic growth. Inflation is the increase in prices caused by the increase in demand for products. This is why people say it's a sign of economic growth. The Federal Reserve tries to make sure there's at least 2% inflation per year. The problem is sometimes people's wages do not increase at the same price as inflation. So if you're making the same amount that you made last year, but inflation rose by 2%, you can now afford 2% less stuff. Reasons why it's called a silent tax. Inflation is the reason why you should invest in a retirement account, not just putting it into a savings account. The fifth term is the federal funds rate. Every 6 weeks, the Federal Open Market Committee, which is a part of the Federal Reserve, which is the central bank of the United States, they meet to decide whether to change or not to change the federal funds rate. This rate is basically the supreme interest rate of the land. The federal funds rate is the rate that banks must charge other banks to borrow money from them to meet reserve requirements. When the federal funds rate goes up, it makes borrowing more expensive, so banks are more hesitant to loan out money. The less loanable money there is to give out, the increase in other interest rates for things like homes, cars, corporate debt, whatever. So if you hear people making a fuss about the Federal Reserve increasing the federal funds rate, this is why, because people with debt are going to have to pay more. Bottom line, these are just a few of the terms that you will run into as you get older and become more financially independent and stable. When you're dealing with things like applying for a loan, paying your taxes, or negotiating your salary, these are some of the terms that will be helpful. When it comes to your finances, it's not a what you don't know can't hurt you situation. It's the exact opposite. If you don't know what something means, always ask. If the person cannot explain it to you, that probably means that they don't really know what it means either. And until you really know, you shouldn't be making any decisions. So this Financial Literacy Month, take time to learn some new things to help you achieve some financial freedom. Watch some of our older, amazing, classic Mo Money episodes. You'll be glad that you did. For now, don't forget to like, comment, subscribe, share, Follow me on Twitter, follow me on Instagram, like me on Facebook. Check out themomoneyshow.com. Mo Money, signing out.